very much for joining us. My name is Richard Betts. I'm the group publisher at Real Asset Media, and we run a series of these events as well as magazines, newsletters, and multimedia. This is part of an initiative that we've been running really since the crisis, doing more in terms of being able to connect the community, producing special reports, but as well as 60 of these types of events covering both sectors but also specialist topics. As well as Realcast and other different initiatives, including RealX.global, which is designed to sort of create and connect a virtual community. And of course, you can visit the exhibition and also view this as an on-demand content later. Super panel that we've got today. We're going to be looking at how much of what and where asset allocation in the investment markets. We've got Klaus Thomas, CEO of Germany for BNP Paribas, Real Estate Investment Management, Doris Pittlinger, Managing Director for Fund Management Europe at Invesco Real Estate, and James Farmer, who's Director of Acquisitions at Europa Capital. This was a session that was originally scheduled to be part of the Expo Real Hybrid Summit. Unfortunately, as we know, that couldn't happen because of the health crisis. And so I'm very pleased that we were able to allow you to benefit from the insights from the speakers there. Let's just start by introductions. Maybe let's start with you, Klaus. Just a quick kind of minute on who you are and what you do, so that then we all know who everybody is. Klaus.
Richard, thank you very much. Good morning, everyone. My name is Claus Thomas. I'm the CEO Germany for the Real Estate Investment Management arm of BNP Paribas. BNP Paribas Real Estate Investment Management runs across Europe roughly 30 billion assets under management, making us one of the long-standing and larger investment managers across Europe.
Perfect. Thanks very much. Doris.
My name is Doris Pittlinger. I'm heading the European fund management of Invesco Real Estate. Invesco Real Estate is a global independent asset manager with about 71 billion euros assets under management. We're specialized in cross-border investment. And actually, my remit is currently for about 21 different mandates with capital coming from across the world. And we are working on all sorts of risk profiles, the same as sectors. So basically, we are covering all the commercial sectors, but also residential, student housing, and hotels.
Great, thanks very much. James.
So I'm James Farmer from Europa Capital in London. Europa is a pan-European fund manager, majority owned by Mitsubishi Estates in Tokyo. We manage global capital across a range of real estate risk profiles, including value add and core plus, also UK-focused debt. So I've been at Europa for almost, actually over 10 years now, and responsible for acquisitions across various geographies in Europe. Currently look after our acquisition activities for all of our products in Germany and CEE.
I mean, it's a big topic, obviously, this asset allocation one, but let's just kick off, I guess, looking at the capital and overall allocations. And maybe starting with you, Doris. I mean, how do you see the current position in terms of capital flows coming into real estate? And I suppose also looking at that, that view of whether or not we're likely to see more allocations because of bond yields and volatility in the equities markets.
It's probably not coming as a surprise that capital flows, particularly from outside Europe, have dropped significantly. I mean, actually, as a total in the capital flow, I think we're down to levels of 2014. I mean, the big two streams of capital coming out of South Korea and the US have both stopped almost completely. So what we saw in terms of investment, which was, I think, about 52 billion in the year, was mainly coming from European investors. And that is also something that I think we can confirm in terms of our own mandates and where we managed to invest. Now, interestingly enough, we start to see some careful interest coming back from the US, from some of our mandates, suggesting that they would now be ready probably to start investing in Q1 next year. So as I said, slowly, carefully, I think we're coming back. The second part of your question, I think, was more related to the expectation on capital flows and how will real estate do in the context of our low interest environment. Yeah, I think the short answer is the wall of money continues to be there. So against that background, I think there will still be strong investment into the real estate sector. I guess most people will continue to retrench a bit to their home countries, or at least their home continents in a way. But as I said, we see careful signs of people starting to look again outside of their home country.
Okay, good. Thank you, Doris. And Klaus, are you seeing, I mean, do feel free to pick up on any of those points, but are you also seeing that sort of retrenchment into domestic markets?
Absolutely. On the one hand, as Doris described, because, just practically speaking, travel is quite limited or restricted actually at the moment, which means, that international investors coming from other continents, like the Koreans, for example, or the Americans, simply can't assess an investment if they don't have a presence in Europe already. So that's definitely a practical hurdle. On the other hand, in terms of market, also seeing that there is still real estate well positioned as an asset class. Having said that, there's definitely a sort of a certain pause with investors on the one hand, because all increased their allocations to real estate over the last couple of years and would consider themselves, with being well allocated to real estate. However, the next sentence then is always, but if you have an interesting opportunity, please let me know and let's discuss. So there's definitely appetite out there. The asset class is still well positioned to provide decent returns in an overall asset allocation. So the appetite remains there from our point of view as well.
And James, I guess, how are you seeing that at the moment? How do you see the outlook, particularly in terms of the allocation also? I mean, you mentioned there Mitsubishi. Are you seeing a kind of stepping back from real estate, or actually more of a move towards real estate in some ways?
I think everyone still supports real estate and investment in the sector. I think the biggest point is the restrictions on travel, because people can't get to the markets they want to get to, and that really causes logistical barriers that we're actually taking advantage of right now, especially for our value add fund, because the market's quite frankly not as busy as it was this time last year. This time last year we were battling against a lot of US, South Koreans, etc. At the moment, most of the markets are dominated by the domestics, and we've got a little point in time where the international markets are not quite as busy as they were. Just
looking at that, are you seeing any particular focus in terms of countries, James? Just picking up that point, is it more difficult operating some countries rather than others? Does it help if you can actually be in Germany, for example, like Klaus and Doris are for investing there?
Sure, of course. I mean, obviously the travel restrictions and quarantine, does cause huge issues, especially for a sort of pan-European fund manager like ourselves. But we're lucky we have a large swathe of partners on the ground acting for us in each of the geographies we're active in. So it doesn't really restrict us. I would say there's definitely been a retrenchment to the core continental European markets. Germany, for example, I think is actually increasing in popularity, principally due to its macroeconomic strength. Countries like France, Netherlands, and some of the Nordics will probably come out of this quite strong as well.
I'm going to pick up the countries and also some sectors shortly. Doris, I just wanted to see, how do you see investors at the moment looking at the European real estate markets? Obviously, Invesco, global. How, I suppose, are they seeing the capital seeing European markets versus, let's say, Asia or North America? Do you think Europe is well positioned to sort of pick up and benefit from some of this capital?
Over the longer term, for sure. I mean, we had the theme earlier about the retrenchment to sort of your home country or your home continent. But I think in the forthcoming 1 or 2 years, what you can clearly see is that Europe's weathered that COVID storm, in parts at least, way better than some of the US at least. I think from an Asian perspective, they are anyway ahead of us in terms of managing health crisis of that nature. So therefore, I would actually expect to see some capital flows out of Europe going into Asia. So it's possibly more the other way around. But from the US, I mean, I hinted that initially already, I think we are seeing some interest coming into that. But let me just go back for 1 second to what James said earlier about Germany and the attraction. I mean, when you purely look at the figures, then actually you would assume that Germany and Denmark are the two big winners out of this because they had the highest capital flows. Now, I think we need to take that with a pinch of salt because in the end, particularly with Germany, that masks the fact that we have had huge transactions there, which were, that ADO buying Adler and that kind of thing, which doesn't quite tell you what really the underlying is. So we didn't see many smaller transactions. We saw that big one. And that now looks as if we are kind of up to levels of last year. But to tell you the truth, it's not the case. Still, Germany's got its attractions and obviously is being seen as a safe haven. But I just wanted to put that picture sort of in context.
Let's pick up Germany as well, since we're on that topic. And Klaus, you're obviously CEO of Germany for BNP Paribas Real. How are you seeing that market? Because absolutely right, there is a sort of view of Germany as a safe haven, and also partly because of I guess the way that it's dealt with the health crisis. Certainly, if you're sitting in London and looking at it, you're thinking Germany's done better. How much of an influence of that, and I suppose how are you seeing international capital looking particularly at Germany at the moment?
Probably starting with the market as such, what we've been seeing after I would say, now looking back, relatively short break of something like 4, maybe 6 weeks in March, April, the market has again picked up quite considerably, particularly on the core side. So we see quite a few offers in the market on the core side with quite competitive pricing. So in some markets, in some sectors, prices are not even back to pre-COVID level, but continue to increase, not at the same speed as it was in the last couple of years, but the trend is still going upwards, or for yields going downwards. But that's for the right product, quote unquote, meaning mainly on the core side, long-term led, good quality, etc. We see much less of offerings on the probably more value-add opportunistic space because there seems to be the expectation from potential vendors that they may not achieve the pricing that they were hoping for probably at the beginning of the year. But still, crisis also means opportunities, so there will be the occasional opportunity in that respect. The debate that there is, on the one hand, there's a high interest because of all the things that we already said, macroeconomic strength, etc. But when they then are confronted with the real life figures in terms of potential or actual yields that are achievable at the moment, we're down in many sectors to 3.5%, 3% for very good quality, even below 3%. That, of course, is dampening a bit the enthusiasm because they were also expecting higher returns, and at the beginning, we're even expecting discounts because of the health crisis, which, as I just said, is clearly not the case for the good quality assets. However, the options for quite a few investors, particularly on the institutional side, are limited at the moment. Many are on a wait-and-see position for most parts of Southern Europe. Then it comes basically to the large countries, UK, France, and Germany. UK, again, probably many people being cautious because on top of the health crisis, you also have the uncertainties around Brexit, which may have another additional negative impact on the whole situation in the UK, which basically leaves you with the two remaining large markets, Germany and France. And again, there, Germany being probably the one that seems to be better positioned at the moment. So a lot of capital, domestic capital, as well as international capital, at least theoretically, looking into Germany, which makes it still a very competitive environment here if you want to invest.
Let's look a little bit about the appetite of investors, because obviously that's going to be driving the asset allocation going forward. What do we see in terms of capital allocations, capital raising? What strategies are gaining traction at the moment? And that's for anybody, but let's start with you, James. What are you seeing in terms of capital raising, and what are the investors looking for at the moment?
I think there's interest certainly for both the value add spectrum, and it's probably quite an exciting time to be investing in the value add space just because of the dislocation in the market caused by the restrictions on travel. We're definitely seeing interest on the core side and the income side, and I think money definitely wants a sort of safe harbour, anchored by long-term income. But I think at the moment the opportunity definitely is in the very much the sort of value add end, I think that's probably the most exciting part of the market right now.
Okay, good.
Sorry, can I challenge that for a second, James?
Of course you can.
I mean, we've
Absolutely.
we have actually got a value add fund as well. And I think the question is really, when you look at the current gap between occupier demand and the pricing that's out in the market, and with a value add fund where you do have short holding periods, a short business plan. So how do you get your underwriting right if you say you've got a 2 or 3 year window when you buy something at this point? I think that's what I perceive as a bit of a challenge. And I am with you. It is the time for value add funds, but I would probably put the timing a little later. So rather to 21 than necessarily to 20. When you have a little bit more visibility around some of those issues.
I think it depends. Look, I do agree with you. It depends what sectors we are talking about. I think we have very, very strong conviction on residential, and we're seeing very, very strong rent collection in that sector. Likewise, in the industrial and logistics space as well. I think the whole COVID pandemic has really accelerated the e-commerce trends. Look at what's happened in the US, and that will happen over probably a quite short space of time now in Europe. So we have very, very strong convictions on those sectors. Offices, quite frankly, we've spent the last 6 months sitting in our offices at homes or wherever we do our work these days, pondering, what is going to happen to the whole office sector. And I think offices are definitely harder to underwrite than industrials and residentials. So I kind of agree with you, but, I think you need to look at the sectors as well. Offices are harder to understand than residential and industrial, for example.
You've opened a whole Pandora's box there, James, of the sectors. So let's dive into it. Klaus, how are you seeing, from your perspective there, how are you seeing that discussion around offices and I suppose that allocation discussion as well?
Well, starting with the office theme, of course, it's unknown to a certain extent. I think the major impact will come in the near future more from the recession rather than from the health crisis, where we all hope it's over in 9 months' time, 12 months' time, at some point in the foreseeable future. And then, of course, the overall demand will go down because of the recession deriving from the health crisis. However, of course, we're also in that debate about home office and do you need an office at all? We're actually convinced that, yes, you need an office, probably even more so because of the home office situation. People will more work from home going forward. I think that's established, and I would see that definitely as a positive thing in terms of more flexibility for everybody. On the other hand, I think it makes the need for an office even stronger because as a company, you have to physically actually allocate yourself and give your colleagues a room where they can meet and identify themselves with. Then rather than just sitting in their offices or studies and doing whatever they do, and it's more or less then irrelevant which business card you're carrying. So I think in terms of corporate identity, the office, at least in the service sector, I think will become even more important as a point of identification. It may change in the terms of use. We probably may not need, huge farms of desks on open space floors, but more flexible space, where people actually can physically meet, where they can create new ideas. And that's much better if you see each other physically rather than being on screens or on telephones. You need flexible space, meeting space, creative space, office space. In the traditional form, you probably can compensate to a certain extent with home office. But that does not necessarily mean that you will need significantly less space.
Doris, it's interesting because there's obviously at the moment a sort of funnel of people wanting to move into areas like logistics and things around residential and move out of other sectors. But actually, asset allocation is very difficult to do in the sort of reactive way that the market is moving at the moment. I think because, it strikes me, I don't know what anybody else thinks on this, but the discussion around office has changed, quite a lot over the past 6 months, where initially everybody felt there would be very limited in comparison to other areas like retail, for example. Then people were more concerned. So I don't know how much of a challenge is that when you're actually having to make allocations around this and things are changing so dramatically?
I'd say that this is an ongoing process, at least within our company, for the last 3 to 4 years already. Because the challenges around retail are not new to anybody. They've just been accelerated throughout the current situation. Offices, just before we get too hooked up on the future of offices and not existing future, what have you, and everybody working from home. If you take a quick look at the fundamentals, then what you see is that compared to where we were, say, after the global financial crisis, there is rather a lack of supply, of good supply. So I think the fundamentals are still right for the sector. And let's not call it dead at this point, because frankly, I'm completely with Klaus. It will change. So what we will see is offices being a place where obviously people meet, so less desks, more meeting space, and it will have to be very central. So I think any assets that are very centrally located and that offer sort of the one-stop commute as well. So say around Paddington, to use a London example, where you actually have walking distance then. I think that's what will succeed in a way. And of course, you're absolutely right. Asset allocation is not something which you change within, let me say, 2 months. Just because it takes you about somewhere between 3 and 6 months, and probably James can sing that song, until you buy or you sell an asset. So I think the understanding is that needs to be a global or a strategic allocation, which takes you at least 2 years. And frankly, that's the way we approach it. Because even if you asked us today, what have we changed throughout COVID? So how did we change our allocation policy? The boring answer would be not at all, because we continue to like the things which we liked before the crisis. And we also are wary of the same things which we were wary of before the crisis. So yes, residential and logistics are obviously the flavor of the day. I think if you ask me about the real opportunities, and I know you may ask that question at a later point, then I think they may lie a bit elsewhere. Or if we look at logistics, then for example, everybody is now running after something which is long let, where you've got a strong covenant and it's long let. Well, the opportunity may lie though in those which are strategically located, but have a weak tenant on it. You just need to get ready for that and basically then change the tenant. That I think is where you can probably make money out of logistics, because right now, let me say at 4%, buying something long let to Amazon, well, feasible if you put a 50% leverage on it. But frankly, there won't be a lot of rental growth. Never has been in logistics.
James, I just wanted to pick up with you. I mean, that point about acceleration, is that something that Europa was, so looking at, if we compare, let's say, the allocation to the different sectors 2 years ago or 5 years ago to now, are you looking at it in a different light now because of the health crisis and or the economic recession that's likely to come after that? Or is it rather an ongoing continuum, really, that this is changes that were already happening in terms of your asset allocation towards the sectors?
Yeah, I mean, absolutely. I mean, it's obviously for any fund manager, it's an ongoing continuum. It's something you're constantly asking yourself. In terms of which product we're talking about, I mean, we're quite fortunate having pretty much all of our dry powder available to us in our value add fund. And we've all been sort of sitting at home, putting a lot of work in terms of research. And I mean, I would say the sort of whole COVID pandemic has certainly, if I was a sort of betting man, I'd say we're going to do less in the office space now than we would normally typically do. I mean, typically we're quite a big investor in the office sector on a pan-European basis. We'd normally do, I don't know, somewhere between 35 to 50% of our fund in that space. So I would say that will probably reduce, and we'll probably end up going overweight in the whole logistics and industrial. Doris raised a really good point. I think everybody's chasing 10, 15 years to Amazon. There's not so many opportunities in that space. So we're looking at very much shorter leases in good locations. We're looking at different modes as well. So I think, there's definitely room for not just big box distribution, but last mile as well. I think the whole story behind last mile is very, very interesting. And of course, we've always been quite a big investor in residential as well. And that won't change, certainly in the BTR space. So I think if you look at our pie charts, definitely shifted. If I was a betting man going forward, compared to what it historically has looked like, more in favour of industrial and residential than offices. Retail, of course, is off the menu completely.
Okay, for you, James. Okay, great. Klaus, I feel free to pick up any of those points as well. But I just wanted to drill down a little bit into the office part as well, because asset allocation is not plainly just about sectors, but it's also about the types of assets within those sectors. Certainly in some of the interviews I've been having, people are beginning to look at less towers and more ones where there's, it's lower rise and there's an ability for people to walk up and down stairs rather than squeeze into a lift. What's your sense of that? Does that make it more challenging for areas like Canary Wharf or some of the big areas, La Défense and areas like that where there are a lot of towers? What's your sense of that?
Well, I think there's more sort of the cyclical challenge, because those locations, La Défense, for example, are sort of an overspill location when CBD is really full or for really large occupiers. And when those are struggling, then you feel it's the tilts towards the upper and the lower are much larger in those locations, and you might see that, but more deriving from the recession rather than anything else going forward. But that does not mean that a location like Canary Wharf or La Défense will not have a future going forward. You just have to take that into account and always count that in, regardless of the place in the cycle when you go into that type of market. I would just probably add to the discussion around sectors, just one final point, because we are one of the players in that space as well, is healthcare, being certainly also a much smaller niche sector than logistics, for example. But that's something where we also see good demand, and we are also one of the ones in trying to invest more into that sector. Also, in terms of capital allocation, we're able to do a first close in that fund in the height of the pandemic. And again, it's all about being even more diversified going forward than we were in the past, probably.
Does anybody have a good word to say for retail? We've decided that the office is not dead. Allocations to retail, is everybody going to be dropping allocations to retail, or are we going to be talking more about that there's food retail or blended retail, or that this is then part of a mixed use strategy? It seems to me that people are always going to shop. The question is whether is what that will be. So how do we look at retail going forward?
I think I'd like to make the case also for high street retail. Actually, we invested quite a substantial volume into Paris High Street this year. And frankly, I think that's something that's definitely going to come back. I mean, if you believe in the future generally of travel, of people going abroad and enjoying sort of the shopping in those real capital cities, then that is an area which will definitely come back just as well. So I think it's much more resilient than, say, the mass market. What we would not touch at the moment is shopping centers, because that combination of, leisure experience and what have you, which you need to bring into it, just eats a lot of investment, which kind of just, kills almost your returns on that. So that's an area where I think we stay shy of for the time being. But food, yes, food is pretty obvious. Long-term led, ideally. But on the other hand, as I said, the high street is something that we certainly have on the agenda.
Okay, good. And food retail, I think, Klaus, in Germany is quite a strong asset class.
Absolutely, yeah. And again, I think it's you have to take the bigger picture, like where is the retail located? And of course, a good retail would add to its environment in terms of, quality of space, quality of people like to go there, like to be entertained, once that's possible on a larger scale again. So temporarily, probably a dampener again there. But overall, again, for the right retail, we're still buyers there.
Doris, Invesco obviously also well known in terms of hotels and that sort of things. Hotels and leisure has obviously been one of the sectors that certainly from talking to others and the reporting on it, that people are wanting to step out of because they see that as an issue alongside retail. What's your sense of that? I mean, is it something that you will begin to underweight slightly, or do you see, is this really a short-term issue with then, I guess, a bounce back?
Firstly, I don't share your view that people are trying to step out of it. I think what we will probably see is a hold in terms of additional capital. But on the other hand, there is already capital raising ongoing for the opportunities coming into the market probably in 21. And that's quite successful. And actually also our investors in our open-ended hotel fund are looking very positively at that, partly for those who are not drawn yet. They are actually eager to be drawn because they can see that recovery coming in. So we're pretty much convinced that it will probably take us until 2023. So this is not going to happen in the next 6 or 9 months. But in the course of the next 3 years, once we've got the vaccine and I think things go back to a bit more normal, you realize that travel is going to be ongoing as it did in the past. Of course, there will be sort of a bit of a change in the landscape of the hotel operators. It's a bit like only the best will survive because it is tough at this point. But I think we as landlords and owners of the hotels also have an obligation here. So we need to come to the table, and particularly for those who we want to survive and who we feel are the right ones and whom we worked well with in the past. I mean, these are the parties that you just need to give a hand to and see how you also protect your own values by just watching people getting insolvent or, you know, using your bank guarantees. That's not a solution to the problem, in my view.
I mean, we got hotels here, not as a dedicated fund, but as part of our multi-sector diversified funds, and absolutely very similar views. Yeah. We think currently there are difficulties. You have to deal with them. You have to understand your clients, your tenants in particular. Yeah. But it will come back at some point in time. And we still see that as a mega trend, meaning that as it did in the last 10, 20 years, over the long run, hotel or the hospitality sector, yeah, which is becoming also more and more diversified, should thrive again. Yeah. We actually are one of the few investors who actually bought a hotel recently here in Munich. We were able to sort of renegotiate terms a little bit while we were coming into the crisis. We are convinced that this is a very good long-term investment, first of all, and we were able, because of the timing, and we were doing the signing actually in May, that we were negotiating terms for the benefit of all parties involved. So for the vendor, for us as a buyer, obviously, but also for the tenant, to make it so to say COVID-proof. Yeah, so there were a couple of provisions that help the operator to go through the crisis, but also giving us a bit more security than we usually would have gotten. Yeah. So that's an asset that we're very convinced of, and from a risk perspective, we're very convinced that we will not lose money on that asset, because there's also alternative use possibilities, et cetera, et cetera. And on the other hand, when things pick up again, it will be a very good investment for our investors.
Let's pick up a little bit. I mean, you mentioned residential, James. And for you, does that residential cross over through into student housing and senior living and all forms of residential? And I suppose, how do you see those markets in general in terms of asset allocation? You thought that there might, you were mentioning that your allocation to residential had increased over a period of time. Do you expect that to continue going forward?
Absolutely. I mean, look, we've always been quite a big believer in this sort of European-wide PRS market and a big investor in it, and in the that includes UK. So we think that the long-term demographic fundamentals, certainly in the sort of capital cities and bigger cities of Europe, are supportive of investments in that sector, and we'll continue to be very active there. You mentioned students and other senior living, etc. I mean, for us, it's a small sector. We struggle with scale, I think, investing in that niche part of the market. But I think that the sort of demographics and dynamics behind it are quite attractive. But for us, it doesn't really fit. And just going on from the hotel discussion earlier, we fortunately exited our last hotel position in December, which is probably quite well timed. But at the moment, there seems to be a real sort of standoff between current perception of risk and where pricing should be, notwithstanding the fact I completely agree with both Klaus and Doris. The sort of medium to long-term fundamentals are probably quite strong.
And Doris, obviously, how do you see that sort of residential side? Obviously, an awful lot of deals in Germany, particularly for that. But Invesco, obviously big in North America, and there's a very thriving, as well as student, but also senior living and various other forms of residential multifamily. Do you think there's going to be an increase in allocations here to that living sector?
Absolutely. I mean, we started about 6 years ago building up our residential strategies within Invesco Europe. I mean, you mentioned that in North America, Invesco is probably one of the biggest investors in multifamily. For us, we started off in Germany, and we then moved on to the UK, and now have basically all across Europe residential holdings. We're just about to launch our new fund that deals with pan-European investment in residential. And that will allow us as well to take in a few shares of probably, let me say, the more creative living. James, you just said it's niche sectors. I don't disagree with that, but that's one of the reasons why we felt in a bigger context that that's very doable. And we're absolutely looking forward to that and realize that there is a lot of interest in the market. So there's no doubt that we will increase our allocation into residential just the same. I mean, that's what I mentioned earlier about the trend that started probably something like 4 years ago, where we already started to shift away from retail and offices and more into, we call it everything with a bed in it. So that's a strategic theme. From an Invesco perspective, we are focused on what I'd call senior housing. So we completely exclude anything like care services. That is partially because of, let me say, the governmental influence in quite a number of European countries into that, and the reputational risks resulting from that. And then also that sort of scattered environment in terms of operators, which are there. So against that background, senior living, perfectly fine. We understand there's a secular trend here, given the aging population. But the care sector really is not something that we as Invesco do touch at this moment.
Klaus, you mentioned before, that healthcare was a sort of slightly more niche sector and coming forward. I mean, other things that have that look as though they should come forward more, which is data centers, science parks, particularly life sciences, have had a big increase in terms of focus. How do you see that? Are these all too niche, too small, really, for sort of larger scale asset allocation? Is scale the issue, like James was talking about, for these? How do you see those?
Yes, and that's a bit the question here. The one thing is the trend is such, and there are definitely niches that where data centers, for example, it's obvious that this is an asset class, if it's an asset class at all, that will continue to become more and more relevant, given the whole mega trend on technology, et cetera, yeah. However, if you, as an institutional investment manager, want to build up a position into that sector, into a new sector, you have to be confident that the market is deep enough and provides enough liquidity that you can deploy meaningful probably starts at 150, 200 million euros equivalent of capital, at least equity. So with some leverage, we're talking about 300 million. You need to be able to deploy that in a market where you are not one of the few players actually that you move with one deal the whole market. And data centers is an example that we've looked in the past and figured out, yes, very interesting. Everyone gets the theme immediately. On the other hand, it's a very shallow market, meaning there are just very few assets that are there, and 50% of those are occupied or owned by the owner-occupiers anyway. So definitely observing those type of sectors. The questions about practical investability of those sectors that varies amongst those niches.
I mean, it'd be interesting just to pick up, James, in terms of the sort of challenges that we're all seeing at the moment in the market. What are the key ones for you, do you think, as an investor at the moment, in trying to get the transactions going through that are needed to meet the asset allocation that that the funds or the investors are looking for?
I mean, look, everything I'm sure everybody knows is much harder work these days than it was this time last year, principally because most of us are stuck at home and can't get together in person to work a deal out if we're working on a transaction. So, the whole DD process takes longer, bank financing takes longer, legal contracts take longer. So there's definitely a slowdown in the whole sort of deliverability of transactions. The one positive I would say is I think bank finance has probably started to ease over the last 6 weeks to 2 months. So I think there's definitely a bit more banking liquidity. But yeah, and the main thing stopping all this is the whole global restrictions on travel. That is still going to impinge on investment volumes and getting deals over the line probably until spring next year, or whenever a vaccine magically emerges.
I mean, one of the things that's been very noticeable, I think, has been the increased focus, not surprisingly, on wellness and health and those aspects, but ESG in general, and particularly the S part of that, the social part of that. Is this something that, in terms of asset allocation, means that this is something that's being driven by both the occupiers as well as the investment capital? Is this also going to be very much a deciding factor in terms of where you're allocating? Is it all going to need to be completely the best ESG it can possibly have? How do you see that moving forward?
I think it is an integral part, first of all, of the transaction process. So you will certainly double check on those aspects. But frankly, does it have to be the best at the time you buy it? No. I think actually the opportunity potentially lies in you developing that. I mean, you just need to be aware of what actually the requirements are so that you can decide for yourself, can I get this asset to a sustainable standard, to something that meets 2050 carbon neutral, that will hopefully show the right sort of data that you do want to see. And particularly on the S part, I'd say that is the one where you can work the most yourself as a landlord together with the tenants. I mean, you can do all sorts of things that really fulfill that S part by, doing certain things in your office space, in your retail space, which will belong to the social, or which will allow for that social projects to go ahead. So I think in a nutshell, what I'm trying to say is, no, it doesn't have to be perfect at the start. You just need to be aware of how you get it there.
And in general, sorry, Klaus, you wanted to pick that up, I think.
I just wanted to add to that. I think that's probably also for the benefit of the whole ESG. And I think we all agree this is something that is absolutely necessary and will not go away. Actually, it will increase in relevance more and more. But that's also probably what we can contribute as an industry to the whole thing, because there's a lot of particularly existing stock that is okay, but needs improvement. Tenants will ask for better buildings going forward, in the light of the whole discussion that we also had previously in terms of quality, etc. But also in the terms of the tenants are more and more sensitive to what buildings are they moving into, what landlords are they moving into or dealing with. So it's quite relevant. Apart from, I think that all of us, as I already said, are personally convinced about it, it's also absolutely relevant for the business that we all improve on that. And it's a journey. So there are no set solutions yet. There are a couple of basics that I think now everyone is sort of doing anyway. But it will be a long journey with many trials and probably some errors in that respect to improve on all of these sectors. And the social sector, or the S in the ESG, is on the one hand, I think, the most tricky one, because in our industry, we all like to measure things. We like to put figures, scores, data right next to it. And the social aspect there is probably the most difficult one in that respect, meaning that it also probably opens the opportunity to be more sensitive to other, more softer aspects. So we probably can go out a little bit indirectly by improving over the long term your tenant quality, for example, because good tenants like your building more because there's, for example, childcare possible, or there are other things in the building where people just, feel better and like to go to, rather than other buildings or other locations where they just say, and some might not even know why, but they say, okay, I like this, and I like that landlord, I like that asset, I like that area, versus another one because it's just, quote unquote, feels better.
No, that's interesting. And James, from your perspective, I mean, if you're looking at, if you're looking at that value add side, is that part of the value, like Doris was saying, that's something that you as an investor can add, that it's an existing asset that maybe doesn't reach those, the ESG criteria going forward, that's something that you can add, or if you're looking at a kind of 5-year to 3 to 5 year horizon, is that more difficult?
Yeah, again, look, a really good point. And I think, for an active asset manager like ourselves, it's completely relevant and always in the sort of forefront of our minds. We take on a lot of office projects, typically with a high degree of vacancy or short walls, where we are having to adjust space for its, for its modern requirements. And we're seeing, quite frankly, tenants becoming more demanding. So we are having to invest more in those buildings, more in the sort of social, the S part of the ESG, to give tenants a better experience. But we are seeing rental levels increase to kind of reflect the additional capex as well. So you do see you do get some back for the amount of money you invest in the building, and also, of course, if your building is better and offers tenants more amenity, of course you have the sort of uptick in leasing performance as well. You're going to beat a building that's not managed quite so actively and not modern in terms of its spec.
Okay, good.
Yeah, and I think from a value add perspective, Richard, it's equally important, because ideally your strategy is that you sell into a core market once you've done all your active asset management, and that means a long-term holder following that. So if you would ignore those aspects, I think you'll find yourself in a position that strategy wouldn't work.
Absolutely.
If we're looking at asset allocation, that's because we want to find opportunities where we think there's going to be an interesting return that matches with what our investors are looking for. So just in kind of 30 seconds or a minute each, I guess, where do you see those opportunities at the moment, given the current market? I'm going to start with you, Klaus, then move to you, James, and finish with you, Doris, which has given you around 5 seconds to think about it, Klaus. So let's start with you, Klaus.
Thank you very much. We talked about all the sectors, etc., and then I finally identified that there are probably opportunities in each sector, more or less. Yeah. I think that the biggest opportunity lies in the last couple of years, there was a lot of managed to core. I think what we just discussed also at the end, it's managed to ESG, whatever that means. Yeah, but managed to ESG, I think, is the challenge, but also the opportunity going forward.
Okay, great. James?
I think the biggest opportunity for us is, right now, as I mentioned before, the markets are domestic dominated, unless you have the ability to invest in those markets. So we are, we're seeing a lot more traction for our value add fund in products that we never normally would be able to buy right now, just because it's a very small window. In terms of sectors, we've discussed those already. I do think offices are kind of a little bit more maligned than they should be. So I think, we'll see some more additional returns in that space.
Okay, great. Doris?
Thanks for giving me the additional minute. I'll come up then with 3 suggestions. The first one was mentioned earlier, that is logistics with weaker covenants or shorter leases. The second one, which is definitely counter-cyclical, UK offices, or London offices, basically. Because I think we are already seeing a discount there. Everybody's very wary because of Brexit, so it's kind of, we don't touch it. But frankly, there's definitely undersupply. So that's an opportunity that I would really recommend to look into. Thirdly, probably more towards the specialty sectors, life science, I think, is a big theme. We can see that now coming in with the current health crisis, but it's been before already. So as an investor, I think that's something that we should have a specific look on.
Thanks very much for sharing your views. I just wanted to say thank you again to not only the speakers, but also to Expo Real, just for coming up with a program, and I'm delighted that we're able to share it. This is what's coming up next, which is Lisbon Real Investment Talks 2020. So that will be coming up in a couple of weeks' time. So do join us for that. And in the meantime, enjoy the exhibition and the rest of your day. Thanks very much for joining us this morning. Thank you to all of our speakers, and look forward to seeing you at the next one. Thank you.
Thank you
for having us. Bye.